Hi everyone, my name is Gatot Subagio. I am MBA student from IPMI Institute. Now I'm going to share a video that is one of our individual assignments of corporate finance with the lecturer of Professor Roy Sembel. The objective of this course is to give the student problem-solving skills in finance from the point of view of management and investor. Corporate finance or financial management represents optimal orchestration of internal and external financial resources towards significant and sustainable value creation. So the basic objective is create a significant and sustainable value. There are three important parts in corporate finance. The first one is business conduct. It refers to implementation of financial management daily. The second one is as management of the company, internal or inside-out perspective. Focus on how the financial management implement as management of company. The third one is as investor, external or outside in perspective. Focus in how a company operation and strategies affect its financial performance and value rather than solely on internal factors. This viewpoint is crucial for understanding a company's potential and making informed investment decisions. Let's discuss from the business conduct. There are two parts. The first one is fraud risk management. It is a comprehensive approach to identify, assess, and mitigate the potential for fraudulent activities within an organization. Consists of triangle of fraud, occupational fraud and abuse, investment fraud, and fraud prevention. The second one is ethic. Ethical behavior is must. Unethical action violate moral principle or standard of conduct, while illegal action violate the law. An action can be unethical but not illegal, or it can be both unethical and illegal. The next is greed. Is greed good? Greed, for lack of a better word, greed is good at and capture the essence of evolutionary spirits. Also, we learned from some movies. Wall Street, talking about corporative finance, Wall Street 1987, directed by Oliver Stone, is a prominent film that explores the world of a corporate finance, particularly focusing on the themes of ambition, greed, and insider trading during the 1980s. And also Other People Money's 1991. It is a comedy drama film that explores corporate finance, specifically the world of hostile takeover and the ethic of corporate riders. The third one is four-tip incentives. Four main types of incentive are financial, social, moral, and psychological. These categories help to understand the different way to motivate individual and drive desired behavior. Back again to fraud risk management consists of a triangle of fraud, opportunity, weak internal controls, ineffective control monitoring, pressure or a greed addiction, poor cash management, dissatisfaction with pay, overlook for a promotion, rationalization, I will pay back, I deserve a pay rise, it is for a good purpose. And also we learn occupation, fraud and abuse, corruption, conflict of interest, bribery, illegal gratuities, asset misappropriates, cash, inventory, and all other assets, fraudulent statements. And also we have the 7 financial shenanigans, action or omission designed to hide or distort the real financial performance or financial condition of a company. For example, recording revenue too soon, recording bogus revenue, boosting income with one-time gains, shifting current expense to later or yearly period, failing to disclose all liabilities, shifting current income to a later period, shifting future expense into the current period. We also have fraud prevention, build employees' ethics, design anti-fraud controls, train employees to increase fraud alertness and prevent fraud, including IT security, protective security, hardware and software, whistleblower mechanism, and also act of reporting misconduct to manager, executive, or other authorities with the power to take corrective action. So how about the fraud statistic? This is male, middle income, age from 40 until 50, and work experience more than 10 years, and undergraduate and also postgraduate. Move to part 2 of financial management as management of company, internal or inside-out perspective. There are context and basics. We have principal agent problems, shareholders, conflict of interest, ethical behavior, goal of firm value creation principle, GCG and CSG balance scorecard, and also asset and liability management. We have investment capital budgeting, NPV, IRR, PI, payback period, and also financing, capital structure, tax benefit, financial distress factors, financial risk management, restructuring, and dividend policy. We have tax benefit for majority shareholders, signaling theory, actions speak louder than words. Detail of goal firm and investment will be explained on the next slide. It indicates the value created per unit of investment, helping to prioritize and rank potential projects. If profitability index greater than 1 suggests a profitable investment. And also we have net present value. It's a method used to assess the profitability of an investment by calculating the difference between the present value of cash inflow and the present value of cash outflow over a period of time. There are some limitations. For example, project size comparison, discount rate assumption. If net present value greater than 0, the project is acceptable. If NPV less than 0, the project is rejected. And also we have IRR, internal rate of returns, is a financial metric used to estimate the profitability of potential investment, especially in capital budgeting. There are some indicators. IRR is discount rate that results in an NPV of 0. If IRR greater than discount rate, the project is acceptable. And if IRR less than discount rate, the project is rejected. And also we have a payback period. Payback period is the length of time it takes for an investment to generate enough cash flow to recover the initial cost of the investment. And then there are some limitations. No time value of money, only considered time. In summary, payback period doesn't account time value of money, IRR, and cash flow from the project, while the NPV, IRR, and PI consider the time value of money. Financing, capital structure, tax benefit, financial distress factors. There are capital structure theory. The first one is benefit of debt financing is that interest is tax deductible while payment to equity providers are not. Tax benefit: the higher tax rates, the more valuable interest tax shield become, and also financial distress, volatility cash flow startup versus established company. And also we have financial risk management, market risk, FX interest rate, international financial FX instrument and FX market, currency future and option market. And also we have restructuring. We had study case of LBO, leverage buyout Nabisco. The Nabisco LBO is a prominent example of debt-driven takeover and had a significant impact of the financial world. This transaction symbolized the LBO boom of the 1980s and provided valuable lessons about the risk and benefit of using debt in acquisition. The value creation are tax benefit toward optimal capital structure, taking cash out, and conglomerate discount. Last but not the least, as investor from outside in perspective, we have a principle. The story and the people behind the numbers are equally important, if not more important. And also return vs risk, total risk, systematic, unsystematic, correlation and diversification, efficient frontier portfolio. Capital asset pricing model consists of high risk, high return, efficient frontier portfolio, the most return to risk efficient portfolio by Harry Markowitz, capital asset pricing model formula from Nobel Prize winner William Sharpe. And also we have underlying strategy for investment, time value of money, rule of 72. And also we have the method, consists of formula indicators, domestic and global economic analysis, industry analysis, company analysis, financial statement analysis, components, balance sheet, show net worth, profit loss, how profitable, and cash flow, show the cash, and also ratio, profitability, liquidity, activity, leverage market, and also health or net company by natural level, quality of number, historical trend, industry benchmark, decomposition by DuPont analysis, and technical analysis. There are momentum vs reversal, trend up and down trends, support resistance, gap, common breakaway measuring, exhaustion, triangle, systematic, unsystematic, double bottom, double top. Head and shoulder, inverted head and shoulder, moving average, filter rule. And also we have practical strategy from some expert, book review from Peter Lynch, One Up Wall Street, and Philip Fisher, Common Stock and Uncommon Profit Focus, John Burr Williams, The Theory of Investment Value, Discounted Net Cash Flow, and also Warren Buffett, Adaptive Discipline to Update Knowledge, Good with People. That's all for my mind mapping video of corporate finance. Thank you so much for watching, and we have the best quote from our lecturer, Professor Roy Sembel is, "It's okay to do something you wish you would never done, because if we don't do those things, we never grow." Thank you and see you again.